What if the thing you believe is protecting you is actually the reason you're exposed? Most people assume that owning gold or silver automatically puts them on the safe side of history, that just having it somewhere in the portfolio, somewhere in the background means they've done what they needed to do. But history tells a darker story. In every major monetary transition, the people who were most confident they were prepared often turned out to be the most vulnerable. Not because they chose the wrong assets, but because they owned too little, owned them the wrong way, or misunderstood what those assets were actually supposed to do once the system came under real pressure. That paradox matters now more than ever, because what we're moving toward in 2026 is not a normal recession, not a temporary slowdown, not something that resets neatly and moves on. This is a structural transition, one built on accumulated debt, distorted currencies, fragile liquidity, and eroding trust. And in that kind of environment, symbolic ownership is not protection, it's exposure. The line between being prepared and being caught off guard doesn't run between people who own gold and people who don't. It runs between those who understand what protection really requires and those who only think they do. The most dangerous assumption in finance is believing that vague exposure somehow scales when crisis hits. It doesn't. It never has. History shows a repeating pattern that only becomes obvious in hindsight. Long periods of calm create complacency. Complacency shrinks preparation, and when stress finally becomes visible, positioning windows slam shut. By the time most people feel unsafe, prices have already moved, liquidity has already thinned, and the ability to build real protection is gone. That's why the question heading into 2026 is not whether gold and silver matter, but how much is actually enough to change the outcome. Because the difference between owning metals and being protected by them is not philosophical, it's mechanical. In every monetary transition, there's a quiet phase where pressure builds beneath the surface. Debt grows faster than income. Policy choices prioritize short-term stability over long-term discipline. Real yields get pressed down, not all at once, but gradually, almost politely. During this phase, owning a small amount of gold or silver feels reassuring. Nothing seems broken yet, markets still function, confidence hasn't snapped, but this is where the trap forms. When stress escalates, the system doesn't fail evenly. Liquidity tightens in some places and floods others. Policy responses distort price signals. Purchasing power erodes unevenly, quietly. Then suddenly, in that environment, small, symbolic holdings don't scale. They don't offset losses elsewhere. They don't change decision making. They don't buy time. They just exist, watching the system move without you. Gold and silver are often misunderstood because people expect them to behave like investments. They aren't. They don't cancel volatility and they don't remove risk. They act like ballast on a ship in rising seas. Too little ballast and the ship still capsizes. Too much and it becomes unmanageable. The metal's job is narrow but critical to preserve purchasing power when currencies weaken, when policy mistakes compound, and when confidence fractures. That function only works when the position is large enough to matter relative to the risk it's meant to offset. Insurance that's too small doesn't fail loudly. It fails quietly, right when it's needed most. And that is why some is often not enough, not because gold and silver don't work, but because most people never size them for the world they're actually entering. What makes the environment heading into 2026 so dangerous is not that something suddenly breaks, but that so much has already been bent out of shape. This is not a typical slowdown where demand cools, policy responds, and the cycle resets. What we're entering is the end phase of a long buildup. For years, governments have accumulated debt faster than their economies could grow. At first, low interest rates made it look manageable. Then refinancing became routine. Now, interest costs are quietly eating larger and larger pieces of national budgets. Not in headlines, but in spreadsheets. And once that line starts rising, it rarely comes back down without consequences. Political pressure tightens the vice. Election cycles don't reward restraint. They reward stability, growth, and the appearance of control. That pressure flows directly toward central banks, pushing them to support markets and employment even when it undermines currency stability. This isn't a theory. It's a pattern that repeats whenever debt reaches saturation. The system doesn't snap immediately. It strains. Policy responses stretch it further. Liquidity is added, not because it's optimal, but because the alternative is politically unthinkable. This is where the hidden mechanism comes into view. When debt can't be serviced cleanly, the burden doesn't disappear, it gets transferred. Inflation spreads the cost across the currency. Financial repression pins real yields below inflation, slowly eroding purchasing power. Savers don't lose everything at once. They lose it gradually, quietly, year after year, while nominal numbers still look intact. It's like watching the tide rise around your feet while being told the water level is stable because the ruler hasn't moved. History shows what happens when this pressure peaks. Central banks are eventually forced to choose between defending the currency and defending the financial system. They always choose the system. Markets are stabilized, liquidity is restored, confidence is managed, and the currency absorbs the damage. That decision isn't dramatic in the moment, but its impact compounds over time. For savers, the result feels like standing still while the ground slowly sinks beneath them. This is why the environment heading into 2026 matters so much. The escalation is already underway. Debt feeds policy distortion. Policy distortion weakens real returns. Weak real returns punish anyone relying on traditional savings to hold value. And once this mechanism is in motion, it doesn't reverse quickly. It grinds forward, calm on the surface, pressure underneath. And for those watching closely, the direction is no longer ambiguous. When real yields are pushed down and held there, something subtle but dangerous begins to happen. On the surface, everything still works. Markets trade, accounts show gains. Statements arrive on time. But underneath, purchasing power is quietly leaking away. This is the phase where financial assets stop standing on their own and start leaning on policy for support. Prices no longer reflect reality as much as they reflect intervention. And in that environment, tangible monetary assets stop behaving like commodities and start behaving like anchors. The shift has played out before, not as a single event, but as a sequence. First, debt builds to levels that can't be serviced honestly. Then policy steps in to soften the math. Interest rates are suppressed. Real yields turn negative. Savers are told this is temporary, necessary, controlled. Over time, that pressure compounds. Cash loses weight, bonds lose credibility. Assets that depend on policy begin to feel solid only as long as the policy holds. That's when gold quietly changes roles. It stops being a trade or a headline and becomes a credibility hedge, a form of money that doesn't rely on promises. Models, or central bank balance sheets to exist. Silver moves differently through the same mechanism. Unlike gold, it doesn't just sit in vaults, it gets used, consumed, embedded into energy systems, electronics, medical applications, and defense technologies. That gives it a split personality. Part of its value responds to monetary stress. Part of it responds to industrial demand and supply constraints. When liquidity expands and inflation becomes visible, silver doesn't just protect, it reacts faster, harder, in both directions. That's why silver amplifies while gold stabilizes. This is where most people misstep. They treat gold and silver as interchangeable. They follow simple rules, 5% here, 10% there, without asking what risk those numbers are actually supposed to offset. But allocation isn't about copying a template, it's about matching exposure to the environment you're in. In a system where policy support is doing more of the work and real returns are being quietly compressed, imbalance becomes dangerous. Too little exposure and the protection never engages. Too much in the wrong form and volatility takes over decision making. The hidden mechanism isn't complicated, but it is unforgiving. When trust weakens, assets tied to policy wobble, assets outside that framework grow heavier. Gold absorbs stress, silver magnifies it. Used together with intention, they counterbalance each other. Used blindly, they distort outcomes. And as the system leans harder on intervention, that distinction stops being academic and starts becoming decisive. Gold and silver were never meant to protect you from noise. They don't respond on cue. They don't reward impatience. They don't move just because the market feels anxious for a week or two. They work on a different clock, a slower one, a heavier one. They protect across cycles, not headlines. And that mismatch between what they do and what people expect from them is exactly why so many abandon them at the worst possible moment. The pattern is familiar. During long stretches of calm, metals feel dead, other assets run higher, narratives form about missed opportunity. Holding gold or silver starts to feel like standing still while everyone else is moving forward. That discomfort builds quietly. Then, when volatility spikes or prices pull back, people question the position itself instead of the reason they owned it. They sell for relief, not logic. And when the cycle finally turns, when bubbles deflate and confidence cracks, they're gone. Not because the protection failed, but because they couldn't tolerate the psychological cost of holding it correctly. That cost matters more as 2026 approaches, because the pressures building now are not short-lived. Refinancing needs are rising as governments roll over larger amounts of debt into a less forgiving interest rate environment. Political interference in monetary policy is increasing as growth and employment become non-negotiable priorities. At the same time, global trust in reserve currencies is being tested by sanctions, trade fragmentation, and geopolitical realignment. None of these forces resolve cleanly. They don't peak and disappear. They layer, they compound, they sit there, quietly adding weight to the system. This is where the hidden mechanism tightens. When pressures accumulate without release, policy responses stretch further. Support stays in place longer than expected. Real yields remain suppressed. Purchasing power erodes not in dramatic collapses, but through slow compression. For savers, the danger isn't a single bad year. It's a decade where nothing seems wrong until suddenly everything costs more and your financial footing feels thinner than it should. Gold and silver are designed for that stretch of time. The long, uncomfortable middle. The period where protection feels unnecessary, right up until it becomes essential. Owning them properly means accepting that they will often feel boring, frustrating, even pointless. That discomfort isn't a flaw. It's the signal that they're doing their job. Because assets that protect you when cycles break rarely feel good, while cycles inflate. Central banks rarely tell the truth directly. They speak in carefully chosen language, polished statements, and controlled forecasts. But their real message is never in what they say. It's in what they do. And for years now, their actions have been quietly consistent. Despite higher prices, despite public confidence and stability, they continue to accumulate gold. Not because they expect an immediate collapse, not because they're sounding an alarm, but because they are reducing counterparty risk in a world where trust is no longer assumed it has to be managed. This is how institutions behave when they understand the limits of the system they oversee. When you issue currency, you don't hedge with promises, you hedge with something that exists outside the system entirely. Gold can't be printed. It doesn't depend on settlement chains, clearinghouses, or political alignment. It just sits there, heavy and silent, immune to the mechanisms that fail first under stress. When central banks choose that asset, even quietly, it reveals how they see the road ahead not smooth, not orderly, but increasingly conditional. For individuals, this signal is easy to miss because it's not dramatic. There's no announcement, no emergency meeting, just steady accumulation in the background. But history shows that institutions don't move first out of fear. They move first out of foresight. By the time the rationale becomes obvious to everyone else, the repositioning has already happened. Silver complicates the picture in a way that makes it even more revealing. Unlike gold, silver doesn't just sit still. It gets used. It's built into energy infrastructure, electronics, medical applications, and defense technologies. Once it's consumed, it doesn't come back easily. That creates a different kind of pressure. As industrial demand grows and supply remains constrained, silver becomes sensitive to two forces at once: monetary stress and physical scarcity. When liquidity expands and inflation shows up in the real economy, silver doesn't just respond, it reacts. That reaction is powerful, but unstable. Silver moves faster than gold, higher and lower, amplifying whatever force is acting on it at the time. That's why sizing matters so much. Too little, and its optionality never engages. Too much, and its volatility starts driving decisions instead of serving a purpose. The signal from central banks is not an instruction to imitate blindly. It's a reminder to pay attention. Because when the institutions closest to the machinery of money quietly reach for assets outside their own system, they're telling you something about the future they're preparing for, even if they never say it out loud. Enough has never meant owning the most. It has never meant being all in or proving conviction through excess. In every monetary transition, the people who survived were not the ones who dominated a single asset, but the ones who understood what they were actually trying to protect. Enough begins with clarity. If the threat is inflation and currency weakness stretching over time, gold has historically carried that weight with consistency. If the threat also includes monetary stress colliding with real-world scarcity, silver adds another dimension, not as a replacement, but as an extension. The mistake is treating either one as a solution by itself, rather than as tools designed for specific pressure points. This distinction matters because the system doesn't break cleanly, it tightens, it stretches, it forces trade-offs. During these phases, people who misunderstand enough tend to overcorrect. Some pile into metals emotionally, turning protection into concentration. Others underallocate, assuming small exposure will somehow expand in importance when stress arrives. Both errors come from skipping the same step, defining function before size. Gold's role is preservation across monetary distortion. Silver's role is optionality when stress leaks into the physical economy. When those roles are confused, allocation stops serving the system it's meant to protect. Liquidity is where most people learn this lesson the hard way. Metals are strong precisely because they don't behave like cash, but that strength becomes a liability if they're forced to do a job they were never meant to do. Emergency needs don't wait for favorable pricing. Short-term expenses don't care about long-term conviction. When people skip the buffer when they replace liquidity with protection, they create a trap. The moment pressure hits, they're forced to sell the very assets meant to carry them through it. History doesn't punish ignorance first. It punishes poor sequencing. Enough, then, is not an abstract percentage. It's an amount that can sit untouched while everything else moves. It's protection layered on top of stability, not substituted for it. It's sized so that it matters during erosion, but doesn't dictate decisions during volatility. People who get this right don't feel heroic during bubbles. They feel patient, slightly uncomfortable, often bored. And that's the point. Because protection that feels exciting is usually missized, and protection that feels dull is often the kind that still works when the environment finally turns against you. What trips most people up isn't the destination, it's the order in which things unfold. Monetary stress never moves in a straight line, it comes in stages, often spaced far enough apart that each one feels isolated, manageable, easy to explain away. Inflation doesn't arrive all at once. It shows up in waves. Policy reacts late, cautiously at first, then more aggressively once the damage is already visible. Markets swing between calm and panic, confidence and denial, as if testing how much pressure the system can absorb before something finally gives. This is where sequence becomes everything. In the early stages, when confidence starts to crack but inflation hasn't fully shown itself yet, gold tends to move first, not explosively, not dramatically, but steadily. It responds to trust, not headlines. It reacts when people begin to question the credibility of money itself, when real yields no longer compensate for risk, when policy signals become more important than fundamentals. During this phase, gold often looks boring. It doesn't chase excitement, it simply absorbs tension. And that's exactly why many people doubt it. Silver usually comes later. It waits for liquidity. It waits for inflation to stop being theoretical and start showing up in the real economy. When policy loosens, when money spills outward instead of staying trapped in financial assets, silver begins to accelerate. That acceleration feels sudden, but it isn't random. It's the result of pressure that's been building quietly underneath the surface. Monetary stress collides with industrial demand, and the reaction is sharper, louder, harder to ignore. The hidden mechanism behind this sequence is simple, but ruthless. Markets don't price risk evenly over time. They compress it. Long periods of underreaction are followed by short bursts of repricing. People who don't understand sequence experience this as whiplash. They wait too long, expecting confirmation. Then, when nothing seems to happen, they assume they were wrong. They sell patience for relief right before the environment shifts into the next phase. This is why impulsive emotional decision-making is so costly during transitions, like the one building toward 2026, without a framework for sequence. People confuse delay with failure and volatility with signal. They abandon positions not because the logic broke, but because the timing didn't match their expectations. Understanding structure doesn't make markets predictable, but it makes them survivable. It lets you see the storm forming before the wind arrives, and recognize that silence is often not safety, but the space where pressure is quietly gathering strength. When you strip away the noise, history keeps pointing to the same uncomfortable conclusion: protection only works when it's large enough to matter, but restrained enough to survive being held. Across periods of monetary stress, inflation, and financial repression, meaningful protection has often lived in a narrow band, not symbolic, not extreme, roughly 10 to 25% of net worth in precious metals, adjusted for debt levels, income stability, and how exposed someone is to the financial system. That range isn't arbitrary. It's where metals stop being decorative and start influencing outcomes. Below that range, metals tend to function like a psychological talisman. They feel reassuring, but they don't offset losses elsewhere. When purchasing power erodes or policy distorts returns, the position is too small to change decisions or buy time. It exists, but it doesn't protect. Above that range, a different problem emerges. Volatility starts to dominate behavior. Liquidity becomes a concern. Price swings stop being background noise and start dictating emotional responses. Instead of stabilizing the system, the allocation begins to destabilize the person holding it. Inside that middle ground, structure matters as much as size. Gold typically acts as the anchor. It moves slower, absorbs stress, and responds to confidence shocks rather than excitement. Silver sits beside it differently. It amplifies. When monetary pressure collides with liquidity and industrial demand, silver reacts more aggressively up and down. That's why many conservative allocators have historically leaned toward a structure where roughly 2/3 of their metals exposure sits in gold, with the remaining third in silver. Not because it's perfect, but because it balances stability with optional upside. More aggressive structures push further into silver, accepting sharper drawdowns in exchange for greater sensitivity to stress. But this is where the hidden mechanism turns personal. An allocation that looks correct on paper can still fail in real life if it can't be held. Under pressure, numbers stop being numbers. They become feelings. Fear, regret, impatience. The best allocation in the world is useless if it's abandoned at the exact moment it's meant to work. That's why practical allocation reality isn't about optimizing returns. It's about building a structure you can live with while the environment deteriorates slowly, then unevenly, then all at once. The goal isn't to win the transition. It's to still be standing, with choices intact, when the transition finishes unfolding. Gold and silver are not wagers on disaster. They are acknowledgments of limits, the kind every system eventually runs into, no matter how powerful it looks from the outside. Limits to how much debt can be rolled forward without consequence. Limits to how long policy can smooth over reality. Limits to how much trust a currency can carry before it begins to thin. When those limits are distant, metals feel unnecessary. When those limits approach, they feel obvious. And when those limits are crossed, they feel heavy in a way numbers on a screen never do. That's why gold and silver always return to relevance during transitions. Not as speculation, not as rebellion, but as structure, something solid beneath a system that's shifting above it. Enough isn't a number someone hands you. It's not a rule of thumb or a model portfolio. It's the amount that lets you sleep while remaining flexible. The amount that doesn't demand attention every day, but quietly does its job while pressure builds elsewhere. Enough is what keeps you from being forced into decisions when decisions are most expensive. The most dangerous moments in history are not the loud ones. They're the quiet windows just before urgency takes over, when clarity is still possible but rarely used. That window is where preparation actually happens. And that window is always temporary. It's still open. Not forever. But now, the choice isn't about fear. It's about honesty, about recognizing limits before they announce themselves. And in times like these, that recognition isn't pessimism. It's awareness.